And it was basically since the creation of the Fed in 1913, the dollar has lost 99% of the purchasing power relative to gold. So that's pretty substantial. And then it went on to talk about the euro, and it said that it experienced a similar pattern since 1999. So only 26 years, the euro has lost 93% of its value relative to gold. That's pretty crazy. 26 years down 93%. So basically it's depreciated 11.5% a year versus gold since its inception. And there was VanEck, one of the
they're the ones that said gold could go to 189,000.
So they actually were talking about the M2 money supply. The M2 money supply were fully backed by gold. The implied price of gold per ounce would be about 184,000.
Yeah.
That's in the United States. But then if we take into account regions like India, Brazil, Russia, Middle Eastern, basically BRICS. Basically, if we just add BRICS into there, we're talking about 225,000 per ounce.
Since the creation of the Federal Reserve in 1913, the US dollar has lost an astounding 99% of its purchasing power relative to gold. This rapid debasement is a global phenomenon. The euro has lost 93% of its value against gold since its inception in just 26 years. Andy Schectman, a leading precious metals expert, uses striking metrics to show his view that unbacked fiat systems will fail mathematically. As currencies decline rapidly, major institutions like VanEck recalculate gold's true value. If the United States fully backed its M2 money supply with gold, the implied price would be $184,000 per ounce. Factoring in BRICS economic influence, the valuation jumps to $225,000 per ounce. This analysis shows the global money supply expansion pushes a historic revaluation of hard assets. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Look at the deliveries. Even here again in February, so far, we've already seen somewhere like 30 plus million ounces, believe, in that neighborhood, delivered on the March contract. And there's still a whole bunch of time left to go. The open interest is 9 times the available silver in there. And I just think that the big money is using these opportunities to stand for delivery and to subsidize what it is they're getting, at the same time killing that second bird with the one stone and maintaining the perception that all is okay here. Keep on walking, nothing to see here.
Yep.
But the deliveries betray everything else.
There's definitely some logistical disruptions that this war has been creating. In Dubai, given the fact that the airspace has been closed and a lot of flights grounded, a lot of the gold is now stuck there. And from what we're hearing, in the UAE, which ranks as one of the top refiners and bullion exporters, they're also a big conduit for a lot of the shipments in the UK and Switzerland and African countries. They are actually, some of the dealers are having to sell their gold at discounts because they can't get it out at $30 or so less of an ounce.
That won't last long.
How do we get that?
How
do we buy some of that?
We just we're importing gold right now from Venezuela.
Yeah,
but that won't last long. And these disruptions, I think, are temporary. But nonetheless, this is part of the reason why you're seeing the actions that we're seeing, because the disruptions should be far greater in terms of the price and the outcome. When you have the Straits of Hormuz blocked, when you have oil refineries being blown up,
yep.
The price should certainly be affected a whole lot more.
Well, you always talk about the dore, and I love your accent when you say the dore. You're so eloquent when you say it.
Thank you.
But there's a lot of the reports that are coming out with the refiners that they're struggling to source more dore. I know Bloomberg had that India, which is one of the largest refineries, they get about 10% of their dore from the Middle East. So they're having some issues right now. But they do have quite a bit of a stockpile. They've made huge imports in January, so they have enough for now, but depending on how long this war goes on and how long
it's crazy. You see how hypocritical the whole thing is when they are giving India temporary reprieve on their willingness. We are okay with letting them buy Russian oil right now because of this disruption,
right?
But otherwise, it's not okay with us. So it's this. This is the kind of rhetoric, the kind of almost like a monarchy, a global monarchy, where the U.S. is fine. We'll allow you to buy Russian oil right now simply because of the problems that we see in the Middle East and the ramifications. And I find it distasteful. I do. I think this country would be a lot better if we brought all of our soldiers home and protected our country and rebuilt our infrastructure. And it's like the amount of money we're spending, $90 million a day fighting this war right now. 90 million a day. Long before that just becomes outrageously expensive.
It doesn't take very long. You know that. It's already been 9 days.
Yeah, there you go.
It's $1 billion right there.
Right.
And how you doing?
And so as it continues, and that's just numbers that are, think tank is estimated. It's very costly. People are dying. We'd be better off if we just stayed out of everyone's business and made our country a whole lot better. But those are kind of pipe dreams, I guess. So that's what George Washington said on his farewell address. If we would have listened to that, we'd be a lot better off. We'd have the strongest borders. We'd have the most strongest infrastructure. Our military reservists would be here fixing and building and strengthening this country rather than fighting other wars for reasons that none of us really know ultimately what it's all about.
Yep.
So I don't want to get political because that's not what this is about, but it's just a tragedy that
it's not. But at all, at the end of the day, that the politics always plays its part.
Well, but remember, we're spending $90 million a day that we don't have, right? We're broke.
Yeah.
And so, you borrow money to fund the military, which is discretional to fight these wars, that just get you deeper and deeper and deeper into debt while enriching the military industrial. And part of the reason that they wanted silver to stay down for so long, so that they can continue to fight these wars and sell munitions across the globe, everywhere across the globe. But nonetheless, it's ultimately very bullish for the dollar. I mean, for gold, as it will be very bearish for a dollar that will be inflated.
Well, I mean,
there is no other way to pay.
I mean, the DXY, look, we were just down. DXY had hit a low at around 95. And again, we keep talking about the DXY, and it's basically the dollar index, but it's based on the dollar versus against some bullshit currencies, which is really not a true measure.
It's a melting ice cream.
Yeah, that's exactly it. Great. You're like the king of analogy. Love it. I think I got a list of them.
Yeah.
And just that way I can regurgitate them.
People remember stories and things like that. It's better to, think of it that way.
But I mean, now with the DXY is back up to 98 3/4. I mean, it just like that on nothing, on bullshit fears and hopes of what's going on with the war, that's the flock of that's going to be, where they're going as the safe haven to the dollar. But it's all bullshit. We know that it's complete bullshit. But today we saw a nice little rebound. I mean, even before the equity market rebounded and reversed a little bit from red early on this morning in the futures, silver futures were strong all morning. All through last night, I woke up I went to bed fairly early, but woke up at 11 o'clock last night, then woke up again at 2, then again at 3, then again at 4:30. Then I got a client gave me an order at 5 a.m.
The precious metals market faces severe logistical disruptions and systemic pressures. In March, over 30 million ounces of silver were delivered. Open interest for March contracts is 9 times the available physical silver. Large institutions are using these conditions to quietly secure tangible assets while appearing to maintain market stability. Simultaneously, global geopolitical conflicts are creating significant logistical bottlenecks. The closure of airspace in regions like Dubai has stranded large quantities of gold, forcing some dealers in the UAE, a major refining hub, to sell at temporary discounts. Furthermore, refiners, particularly in India, are facing challenges sourcing sufficient doré due to supply chain issues stemming from the Middle East. While these specific disruptions may be temporary, the broader economic implications of funding endless conflicts are not. The U.S. is reportedly spending $90 million a day on military operations, money that must be borrowed and printed, further inflating the national debt and debasing the dollar. Although the DXY index may show temporary strength against other weakening fiat currencies, the mathematical reality of endless deficit spending guarantees a long-term bullish environment for physical gold and silver. Let's get back to the interview.
It was basically since the creation of the Fed in 1913, the dollar has lost 99% of the purchasing power relative to gold.
Yeah.
So that's pretty substantial. And then it went on to talk about the euro, and it said that it experienced a similar pattern since 1999. So only 26 years, the euro has lost 93% of its value relative to gold. That's pretty crazy. 26 years down 93%. So basically it's depreciated 11.5% a year versus gold since its inception. And there was VanEck, one of the
Yeah, they're the ones that said gold could go to 189,000.
So they actually were talking about the M2 money supply. If the M2 money supply were fully backed by gold, the implied price of gold per ounce would be about 184,000.
Yeah.
That's in the United States.
Yeah.
But then if we take into account regions like India, Brazil, Russia, Middle Eastern, basically BRICS, if we just add BRICS into there, we're talking about 225,000 per ounce based on the.
They don't have a dog in the fight. I read that was from their emerging market bond team. I wanted to talk about two things. We'll take some questions after that. The March delivery, it's under pressure. There's 81 million ounces roughly, or 16,250 contracts that's the registered category right now, versus an open interest of 112,700. In other words, you have about 7 times the amount of contracts issued, 8 times the amount of contracts or issued as bars that could theoretically be delivered. That's not good, although they continued somehow to find a way to knock down open interest. Maybe
explain it to our listeners in literally baby terms.
Each contract is 5,000 ounces.
Okay.
And so right now there is 81.2 million ounces. You divide that by 5,000, you'll get 16,250 contracts. Those are bars that are backing the contracts.
Got it.
So
that's what they are available now.
If 16,250 contracts stood for delivery, it would eat all of the registered category. Now the eligible category, that's not counted. Those are bars that are held inside of all people don't want to sell.
Right. They could be yours. They could be mine.
Yes,
so that doesn't count.
No, they could. And it's funny, the COMEX says, well, up to 50% of the eligible category. So you got about, I think, last I looked, 250 million ounces or so. So whatever. But it's not for sale. Anyways, the open interest right now with, what's the date today? The 8th or 9th?
Today's the 9th.
So we got 3 weeks left, 2.5 weeks left. There's 112,700 contracts open interest at 5,000 ounces apiece. That means they could
650 million, roughly, whatever the number comes out to be.
Yeah.
112.7 times
5,000.
Right. So that's roughly the number. That's what could, if they all stood for delivery, then we are basically, shit out of luck.
So the whole thing blows up. But
correct.
We've already seen 6,615 contracts stand for delivery already, which is 33 million ounces.
So it's 563.5 million ounces.
But I want to talk about something that I find to be very, very, very interesting. And here's another way that the media co-conspires with the big banks to create or paint a narrative. So GLD last week saw $4.2 billion worth of gold leave the fund in a single week. And that's at all-time high prices nearly. Right. So GLD just recorded the single largest weekly outflow in its 20-year history. Now, in the media, they will tell you that that shows people are moving. The outflows are leaving to find alternative assets, that they think the gold run is over.
Mm-hmm.
Yet, if you look at it, we've seen these massive outflows and the price is held rather stable, right? If you have that kind of volume leaving, you would think the prices would get blown up. What I am trying to say to you is that this is one way that I think the big money, the big money, is stealing from the ETF in essence to hide their intentions. And stealing is the wrong word. The authorized participants can create or redeem what they call baskets. And those baskets are 100,000 shares each. And the in essence, what they do is they create or they go out and accumulate, purchase shares, create them themselves, and then they redeem them themselves through what's called share redemption and can take the metal out. And so when you see a large outflow, they will tell you that it's the big money repositioning, and it's the big money that is trying to find another place to put their money. You should
reallocation of assets.
Yeah, and instead, this is the APs, the authorized participants, which are the big banks that are taking gold out and silver out of the ETFs very privately without going into the open market and creating what the Commitment of Traders report sees and standing for delivery, which is very, very, very visible. And so this is why I hate GLD and SLV. Not only are they, fully custodied by JP Morgan and BlackRock, but the big authorized participants can create these shares and then pull the metal out quietly And you know, it's kind of like when we saw the price collapse in silver from 120 down to 65. The prospectus says there's a time lag between when they will book the order and then the shares are created. The shares are only created when the bars go in. So they booked the order at $120. The price collapsed, and at the very bottom, 38 million shares
Are created.
found their way into, and they're only created when the metal is deposited.
Right,
So
which is
it's
when you buy,
almost,
what, 70,
did they really
70,
buy it in the
Right.
60s but take the orders at 100 plus knowing it was going to collapse? These are the things that the ETFs allow. If you own an ETF, you're part of the problem. Get out.
The rapid depreciation of fiat currencies is fueling demand for physical metal and exposing issues in paper markets. On the COMEX, the number of open contracts is now many times greater than the amount of registered physical gold available for delivery, creating potential for a liquidity squeeze. Reports indicate that while gold ETF outflows are portrayed as retail disinterest, the reality involves large participants and banks removing physical gold from these funds off market, thereby accumulating gold and keeping prices stable temporarily. Follow this principle. Holding paper derivatives puts you in a manipulated system and at major risk. To keep your purchasing power, secure tangible assets. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Thanks for watching.